Well, good afternoon, everyone. Thought we would do our quick post-mortem on the S&P futures, which is what we were trading today. And let me start with where we were this morning and just kind of see how the day ended up. Here's our risk disclosure. Make sure you read that carefully. Again, remember that these videos are for educational purposes only. Not meant for you to trade, but to learn. So hopefully you'll learn something from each of these as we go along. Little copyright disclaimer. Again, it is June 27th, post-market, post the regular session. I am A.F. Thornton, Chief Investment Officer of Blueprint Quantitative Strategies, and I guess you would call me the designer, the inventor of the Navigator investment algorithm. So we'll talk a little bit about that today as well. If you like this content, help us out. We're brand new. We're trying to build a community here. I'm certainly not brand new. I've been doing this for 35 years, but we're new to YouTube, kind of experimenting here to see what we might be able to add and contribute to the YouTube community. But if you like the video, give us a like. Obviously, if you want notification, join the channel, join our community, and we'll give you future notifications when these videos come up. Remember, I'm just starting. I'll add a lot to the channel as I learn more and as I go along. But in any event, we're at least on our way here. Now, let's go back to our morning notes this morning, and we'll make this just really, really quick, and then we'll go to the post-mortem. Again, we're operating on the theory that we finished the first down leg in this bear market that started in January, and we finished it about a week ago. And there's a lot of evidence at that point that we reached, pretty important low. I mean, sentiment, all the different things that we look at to define a low had lined up actually for a few weeks, and we finally saw it flip. The shape, though, of this downdraft, especially on the NASDAQ 100, but certainly even in the S&P, is a falling wedge or leading diagonal is what I would call it here in Elliott terms. And leading diagonals start a trend. They don't, and actually diagonals can end a trend, but not here. We're just starting a trend. And I see that as much like the 2007 bear, which is the closest comparison I can give you. And so anyway, we're going to continue along that theory. And that being the case, we're going to be in a two-wave up, likely to retrace 50 to 61.8% of the retracement if the past bears are any guide. Again, this is a very unique market. We may not make it that far, but that's sort of the working theory. And at least up through Thursday, we saw a fairly clear opportunity to take the market up to 4,000. I'd say that got chinked a little bit on Friday because there's a lot of options activity filling in and certainly some put buying, but that's certainly still a working theory. And of course, we've talked this morning about the fact that this retracement rally is aligning with the seasonally strong summer rally period. We defined our sandbox, and so the weekly expected move 38.15 to 40.15. That's about a 200-point playground for the week. And we, as I said this morning, we're primarily interested in things we're going to encounter in that range so we can keep our charts uncluttered. Today, the sandbox, just for the day, the expected move for today was 38.50 to 39.75. We'll see how all that worked out. And then again, wanted to talk about the Navigator algorithm gave us a new buy signal at the close last Thursday at 3888.75. At least if you're a swing trader, that was a good entry point, and certainly our swing trading clients picked it up. But again, we're still in a bear market. That was the first leg down. And today we're trading right on the volatility trigger at 39.05, which is also basically where when you get above the volatility trigger, you start to see volatility contract and the market tends to go into more mean reversion type of behavior below that trigger, then you're going to have more volatility, especially in the options market. Dealers have to sell into declines, making them worse, and buy into rallies, making them go further. Whereas above the volatility trigger, dealers basically will sell rallies and buy dips, and that tends to lead to less volatility, more mean reversion type of behavior. So we reviewed that this morning, and I don't want to go over it because you can go listen to the tape. I try to keep these to 15 minutes, but what I did say is a key inflection point that we're at 39.10 to 39.20. It's the highest volume node near us on the chart. It's a huge volume node. If we include all the volume that's occurred at that price since we got to that price, basically. So it's an important area, and these high volume nodes are hurdles, and I said that's going to be a hurdle to get over today. And we recognized that the overnight traders had already gotten over that level, and but by the time we opened, it brought the market back. We had a slight gap higher. Gap rules were on the table, but nothing significant to speak of. I did say that if last week's rally does fail here, we have, well, first of all, we have an air pocket above us, which the market could fly through right to 4,000, and we have an air pocket below us where the market could fall through right to 36.88. So, whichever way we go here, it's going to happen quick. And I wanted everybody to recognize that. So we identified a lot of those key levels, et cetera, et cetera. But let's just, kind of jump into what happened. So, I generally told you that today I was going to try, my approach was to basically lean long because we are in a short-term uptrend. So I was primarily looking for long trades when they presented. Interestingly, the market was a little bit more in a downtrend, especially when we went into the afternoon. So let me get my little profit. I've got an open position there. Let me go ahead and close it, which I forgot to do. And let's get down to, let's look at a 5-minute chart. So basically, we're going to look at the RTH session only at this point, and what we have on the table, we've got the 5 EMA sitting here around 38.50. This is the value area high. This is the point of control today, the value area lows in blue. That's the 21 EMA up on the daily chart, which is considered the mean. There's your volatility trigger. We'll get into the high volume nodes in a minute. These are where all the major options, open options and gamma lie, large gamma levels. So, and of course the volatility trigger is sitting right here as well. So I think that what we saw the market do today is basically, barely open, maybe with a slight gap up. The gap immediately failed, came back down through the open, found support on the 21 here, and really that provided support all day. And as I had suspected the market might do today, remember I said that when you have a large expansion day like Friday, it can typically be followed by some contraction, some balancing, and I'm telling you, it's exactly what the market did today. And you can see that from the volume profile here. Your point of control is sitting here at that important level we identified, that whole 39.10 area. You've got the 21 sitting there. You've got the volatility trigger, which can often provide resistance. You've got basically where that very high volume node is up on the daily chart, and you can see that here if I go to some daily data, and let me just bring it down so that we can just see kind of after we broke out of the COVID highs. And so here is that, high volume node I was talking about right here, and that's exactly where we are. So it's the 21, it's a high volume node, and this is formidable resistance. We're not going to get, out of that overnight. And you can see this was our daily expected move. Now I color this from green to red because generally speaking, if I'm in a mode where I want to go long, I try to initiate in the green part of the daily expected move. And if I'm in a short, I look to do it in the red zone. And then the weekly expected move is sitting over here. And this is our low volume node, which is right about where 4,000 is. And also note, here's your supply line, downtrend line coming from back in March. There's your 50-day line. So, kind of my belief, which I don't stick to. I think one of the hardest things as a trader is to have a belief and not marry it like an opinion. But sort of my working thesis is that if we can get over that high volume node, I'm sorry it keeps changing as I change the data on the chart. If we can get over that high volume node here, then more than likely we can move through this air pocket at least to the 4,000-ish level, which is where that downtrend line and the 50-day line all coincide, especially as they move down throughout the week. But if we can't, then we're going to move down through this air pocket here. And if we magnify that a little bit, and come in just kind of focusing on recent day, you can see that air pocket there, and you've got a low volume node in the middle around 3850, and then you drop down to where your really high volume node support is, which is around 3775, and of course we can make arguments after that. So my thought was, at least this week, with the seasonal strength, the quarter end options expiration coming in at month end, and of course all that is Wednesday, that we could at least have a little wind at our back and move the market up to that level, to the 4,000-ish level. And of course, if this rally is similar to other bear markets, we ought to be able to get beyond that. So I always like to, I do a lot of scientific and quantitative work here. And one of the things I like to look at is I've drawn the bear market to scale. Now I've gone here to a weekly chart, and if you overlay the 2008 to 2009 bear market, you'll notice that right about at this point, we moved from our one wave up to our two wave. And then the big one came basically into the September, October timeframe. And we didn't even, if we're in the 2008, 2009 bear, we're a year away from the actual bottom. And it doesn't hurt to take a look at the one before that. If we go back to the 2000 to 2003 bear, let me get rid of a little bit of the granularity here. Give me 1 second. Let's just look at the main pattern. Let's see. Here we go. Take out these pieces and let's turn 2008 off. So the 2000 to 2003 bear was a little different. We went a little further down before we flipped higher. But once again, we'd be a year away from the bottom if this is any kind of a roadmap. Now, like everything else, I'm going to say this over and over and over. You look at these things for awareness. You don't marry them. The price action, the way I trade, the way I look at the market, I have algorithms, and I basically look at the current price action, indicators, moving averages, a lot of those things. I'm more interested in them because I know that that's where the amateurs put their stops. But I don't use them like a religion. They're just things I'm aware of, just like this. I'm just aware of it. This is how the last two bear markets unfolded. Do we have all the ingredients here for a bear market? Sure. You know what's going on out there. We've got global events. We're in a fourth turning. This is a very, very turbulent period. We go through these every 80 years like clockwork. It's been 80 years since the last one. So there's nothing unusual about what's going on, at least historically and cyclically, even though it's a frustrating period. So just be aware of that. So again, as I point these things out to you, just have awareness of it so that, it's kind of a motto Tom B over at Bookmap always says, if this, then that, if not, then what? That's how you keep from having an opinion. But for now, I think it is safe to say that we're bottoming. We have bottomed. This is a weekly chart again, but we have bottomed this first leg down. Now, the other possibility to keep in mind is if this is a cyclical bear market, then clearly we could be done. Now, I don't think that's the case. And let me throw something out here that I was thinking about today. I'd like to just share my thoughts. There's people are looking at the copper gold ratio. There's a lot of things that people are looking at, and we see obviously bonds didn't have a great day today, but we see signs that okay, the economy might be slowing, the Fed's medicine might be working, but what bothers me the most, even if oil, and by the way, keep track of the oil, I would just run a ratio, the XLE to the XLK. Just, compare technology and energy, because I think it's a pretty good leading forecast for what lies ahead. And I told you this morning, keep an eye on junk bonds. If junk bonds go to a new low on the hourly chart, I don't think that would be deemed to be positive. But what I worry about is, like today, the 2-year auction was lousy. I mean, the rate was very high, the highest it's been, and the coverage ratio wasn't very good, and there weren't a whole lot of buyers there, especially foreign buyers, which is a bit surprising considering that the rates are pretty attractive now. So what I worry the most about is that with the Fed potentially doing QE and everything else that's going on the table, this competition from the BRICS countries, that there's a lot more supply than demand of treasuries. And that really has, it's independent of anything else. It's theoretically possible that the economy could slow to a crawl and rates could still go higher because nobody wants them, right? There's got to be somebody to buy them. And I don't think the market looks very favorably on the government buying them for themselves. We used to call that a Ponzi scheme. So that's something that I'm really chewing on in the back of my mind is everybody's, we're finally bottoming. Yeah, I don't know. I don't think so. So these are just things to be aware of, to keep in the back of your mind. Sorry, looks like I'm a little too close to my mic here. So at any rate, let's just keep our eyes on that. Let me back this mic off a little bit. Like I said, guys, I'm new at this, but I'll get better, I promise. So again, looking at today, let's just look at what happened. We basically came out of the gate with that little gap, but the gap was immediately sold, right? And we came down and we just, for the rest of the day, pretty much bounced off the 21, which is the mean, right near the volatility trigger, which is that gamma flip threshold in the options market, and also near that high volume node that we discussed this morning as well. So, it was somewhat weak because if we take a quick look here, this is the overnight action in Globex, right? So in Globex last night, we came down, we tested the lower end of this range and where the single print started over here from Friday. So we came down to about 38.95, explored the lower range. But most of the volume, I thought was kind of optimistic because most of the volume was concentrated here around 39.2650, which showed some acceptance over Friday's high. But notably, even though we opened with a gap higher, this is today's activity. This is the time at price on the left. This is the volume at price on the right. And we weren't able to take out the Globex high, which I think is kind of interesting. You usually don't make a high in Globex that sticks, so hopefully that's a weak high. But just interesting, a little bit of weakness today. And again, all associated with those levels. But what I saw the market do is come down. We did test and run the stops below the Globex low and immediately came back up into range. We did make one attempt to go higher, but we did fail right here. I mean, we only did, 8 or 6 contracts at that high this morning. We came back down, no interest up here, little or no interest above basically 39.16, and came down and then spent most of the day balancing down here around 39.05. Again, we're at those key levels, the 21, that super high volume node is sitting up here, at least the top of it. And then you've got the 21, and then of course you've got the roundy here at 3,900. So not a very good showing, certainly no follow through from Friday, but Friday was such a huge day. I think the market has every right to consolidate a little bit today, and we'll see what happens for the rest of the week. So we did stay in range today, so we didn't move outside today's expected move. Certainly didn't move outside the expected move for the week. So if we kind of magnify this in here, there's our high today, which is in the upper quartile of today's move. There's our low, which is sort of in the middle. So we did stay within the boundaries today, which is nice. Again, showing that the options market is very inefficient right now and very mispriced. We've blown we've had 2 sigma moves for 4 of the last 5 weeks and blew right through the expected move high and low for the week, which is unusual in my experience. But like everything else, these are just guides. So all in all, more of a balancing day today, especially when we put the overnight action together with, so here's the overnight range, here's the regular session, and I think if you combine those and you kind of just look over here on your longer term profile, up here around 39.50, we're not getting too many interested buyers. Got a little node here at 39.45. We didn't get a bunch of sellers down here. And so fair value today just ended up right along the 21 in those high value nodes. I don't want to sit here and repeat myself, but that's basically what happened. So we'll be here again tomorrow morning for about 15 minutes and, get these down to more of a science. But as far as, I guess I can share one more thing with you as far as the day goes. But like I told you, my plan today was to lean long, right, against, various levels and go to the targets. You can see the point of control moving along here all day. I'm showing you stops, institutional buys and sells. This is the order book. And there were at least a couple of good long trades this morning. And but there were good short trades too, and that's classic of a balancing day. Most important thing for you to do, generally speaking in any time frame, but certainly if you're day trading, is just to try to get aligned with the activity. And what I look to do, is basically I'm just constantly studying where the amateurs have their stops. And if I get a chance to go long into those stops, I'm going to take that chance, and I did that a couple of times today. So, it was a pretty good trading day for me. So anyway, now remember tomorrow, after tomorrow morning's session, we'll go over to the trading room, which is on our website, blueprintquantitative.com. And, subscribers basically pay $2.97 a month for a lot more information than this. And we trade twice a week on Tuesdays and Thursdays. I trade all of these things I'm talking about live in the futures room and in our trading room. So take a look at that if you get a chance. Again, blueprintquantitative.com. So, and again, this is the information you want to learn more. You can email me at Blueprint Trading, and always drop the E from Blueprint. So that kept us kind of distinguished from every other Blueprint out there. So blueprinttrading@gmail.com is how you can email me. The website over there is blueprintquantitative.com. Go to the blog. There's a lot of great information there. Particularly, take a look at our current market thesis. It really hasn't changed since January. And that's the roadmap that we're working based on our analysis of the current market and the bear market. It was nice to see some green on the screen Friday. It would have been nice to fall through today. We didn't. We'll see how it goes. And once again, if you like this content, be sure to hit the like button below the video, subscribe to the channel, hit the notification button, and we'll tell you about future videos. And again, join the channel. We're trying to build a community here. Like I said, I'm certainly not new to trading, and Blueprint certainly isn't new. I'm a quantitative, an analyst, and a math geek, and I write a lot of algorithms and things that, quite frankly, just make my life easier. There's nothing special. It's just a bunch of rules that over time have worked for me and helped me not get too long of a checklist. Let the computer do a little bit of the work. So go over there, take a look around, consider a subscription, and join us in the trading room. We have a lot of fun. Again, all of this is for educational purposes. We're not trying to be a financial advisor, and we don't want to be a financial advisor. I ran a bank, a trust company, and a brokerage firm, and a hedge fund when I was younger, and I got that all out of my system. So all of this is for educational purposes, a chance for me to share what I've learned. And when you join us as a subscriber, it just helps us cover a lot of these costs. Wouldn't it be nice to have someone else doing this production than me? So anyway, but we do have a lot of fun. So look forward to seeing you over there. That's all for now. I'll be on early in the morning. Haven't had a chance to look through everything yet. Notice the put call ratio is climbing again today. The move index made a big move, and I think the interest rate market, the bond market, is still reeling a little bit. That auction today wasn't very good. Although I do think that there are some opportunities in bonds. I went into bonds, did some TLT calls a couple weeks ago, which you'll see if you flip through the blogs. So there are opportunities out there. So I just, it would have been nice to see some follow through today. Would have been nice to see the market a little stronger after Globex. It's kind of unusual when you can't even take out the Globex high. So, but again, I think that's a weak high. I still think the market has a good chance to go up to at least 4,000. It's probably going to go higher if this turns out to be a two-wave, as I suspect it is. So anyway, I'll leave you there. Have a great day, and I'll look forward to being here